This week on the Retirement Quick Tips podcast, I'm talking about why I'm growing increasingly worried about the stock market. High valuations colliding with a recession, a potential recession, is historically a recipe for steep losses, and it is looking more likely that we are at least moving in that direction. Today, I'm talking about the core issue that inspired this week's theme. I read a piece recently put out by Washington Crossing Advisors called The Illusion of Perpetual Growth. This is a white paper they published on their website on September 9th of this year, and you can easily look it up. It's just a couple of pages of analysis, but it's quite good, and I think it summarizes the core issue of where my concerns are coming from right now. They say, quote, over 60% of the S&P 500 index value is priced as if superior growth can be sustained forever, with a meaningful slice, about $8 trillion in market value, priced with an implied perpetuity growth assumption above 10%. I'm going to finish the quote and then I'll come back to this. So here is the central problem. No company can grow faster than the economy forever. So if a company has a 10% perpetuity, that means annualized forever, going out into the future forever, if it's at or around 10% or even above that, that's actually not possible because the US economy is only growing optimistically. Even if you pegged US GDP growth at 5% a year, that's a pretty optimistic growth assumption. So eventually, the math doesn't work. And they talk about this. Washington Crossing says the math simply will not allow it. A firm compounding at 10% while the economy grows at 5% eventually overtakes the economy itself. This is just not possible. So the growth rates that are used to justify the stock prices of a lot of these companies, again, they say 60% of the S&P 500 index value. So a lot of these companies are priced with these high optimistic growth rates that hence justify their stock prices. But it just doesn't work. It doesn't even hold up to basic math. What's happening is the prices are going higher and higher and higher. I mean, even this year, we saw after the tariffs, the market bottomed out in April after the tariffs. These companies have shot up, and we've seen tremendous growth this year, particularly among the biggest beneficiaries from AI and the tech innovation that's happening as a result of that. And so what's happening is we have PE ratios, which is price divided by earnings. And those are at historically high levels. They're not the highest they've ever been. But if you look at what's normal, they're on the high end of the spectrum. And so PE ratios are a gauge of value of stocks because it shows you what investors are willing to pay for a stock or what the price is currently divided by its earnings or profitability. So for every dollar of earnings, investors are willing to pay, right now it's about $23 of share price for every dollar of earnings. That's where the PE of the overall market sits right now. But PE ratios, especially for some of the largest tech companies, are significantly higher than that. So what does that mean? Well, I'll come back to this a little bit later in the week, but generally when you have PE ratios around the level that they're at right now for the overall market, which is around 23, it is not a good omen for the next decade of returns. In fact, JP Morgan did an analysis of this going back to 1988 through the end of 2024. And every time the market was where it sits today, the range of returns, and there were no outliers here, the range of returns was anywhere from negative 2% on average per year to positive 2% on average per year. When you overpay for stocks, even small disappointments can lead to deep losses and a prolonged period of anemic returns. And that's what history is pointing to here in this situation. Okay, what's the takeaway? Well, the market, especially big tech, is expensive by historical norms, and that tends to lead to lackluster returns over the next decade. And right now, we have a lot of speculation, a lot of optimism, not necessarily fundamentals that are driving stock prices to new heights. And that is a concern. Tomorrow, I'm going to turn to my main concern because it relates to the valuation as they collide with an economy that is losing momentum at risk of falling into a recession. And I'll talk more about that tomorrow. That's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.